Many of you guys may have joined us in some of our other presentations. And so I wanted to sort of set the stage. Again, today we're really going to focus on the CARES Act PPP loan forgiveness and some tax updates that have occurred since our last presentation. But one thing I would like to point out is all of our presentations that we've done are available on our website, and we have that information in here, so you can pull up our slides, you can listen to a recorded version of this webinar. We will also be sending out the slide to all the folks who registered. So all of these materials will be made available to you. And again, if you want to just listen to our beautiful voices again and listen to the presentation, you can, or if you just want to steal a copy of the slides, all of that will be available. So again, just setting the stage, what has Washington done with respect to the coronavirus? So they've done it in what they call a phased approach. So phase one was extending some of the tax deadlines back to July 15th. The second phase was the FFCRA, which provided relief to give their employees time off. It was very similar to what a lot of us think of as the FMLA provisions. And then phase three was the really big one. That was the CARES Act, which has a lot of tax provisions in it, but probably more so than that was the PPP loan program. So we probably could have added another bullet to this slide because, as many of you know, the first tranche of money that was given in the CARES Act is gone. So the IRS, Congress reloaded it, as they said, with another round of funding. From what we've been told, there is still about $100 billion left in the second tranche of funding. But a lot of banks, we are being told, are stopping taking new applications because they feel like the applications they've already begun processing are going to account for that money. So hopefully those of you who are on this call already have received your money, and you're listening to our pretty voices explain how to maybe get it forgiven and answer some of those questions. So that's kind of just the lay of the land where we're at today. What I think is really important is and we sort of have been joking when we were putting these slides together, we're getting tired of using the word unprecedented, but that is really the most appropriate term. Typically, when Congress passes a law, they have months to write regulations and give guidance, and people are, this thing is moving so fast that the guidance changes literally on an hourly basis. The Treasury and SBA have actually, I'll give them credit. They've done a pretty good job under a tremendous amount of pressure of trying to get questions answered and release information as best they can. Don't get me wrong, there are still a lot of open questions that are excellent, that commentators differ on their opinion because there's not a lot of granular guidance. So, it's a situation that's changing, like I said, almost certainly by the day and by the hour because new information is being posted. So anything we're saying here, there could be more clarity offered tomorrow or in the next week or so. So you do have to kind of, keep tuned. And we've got some resources in here where you can go to sort of try and stay on top of it. I am now going to turn it over to Eric, I believe, to take away the next portion of the presentation.
Yeah, great. Thanks, Jason. Well, welcome everybody. Like Jason said, I think probably most of our audience is familiar with our firm, but we do have a pretty large audience out there today. So just kind of wanted to give a little bit of background briefly on who we are. But, Briggs & Veselka is the full service CPA firm based in Houston, obviously over 300 professionals across our 5 offices in Texas. We're actually the largest Houston-based independent CPA firm here in town, and recently cracked the top 100 in the nation, which was an exciting milestone for us. For those of you who don't know who I am, my name is Eric Deal. I'm on the B&B Capital Advisors team, which is a fully licensed investment banking subsidiary of Briggs of Veselka. Our team focuses on providing advisory services for buy-side and sell-side M&A, along with recapitalization-oriented transactions. So it's interesting that in the world of M&A, where our team focuses, we're used to having conversations on a what-if basis, or in thinking about a company's future expectations in the context of a transaction and kind of dealing with ambiguities. So perhaps it's, I don't know if fitting is the right word, that we've been involved in these SBA conversations, because even in today's world, we're already more than a month into the PPP, and we still find ourselves having talking about expectations and what if statements, which is a paradigm not normally associated with the SBA. As anyone who's ever gone through the SBA process, it's typically a very structured and oriented transaction. So nevertheless, we're here to share what we know today, as Jason said, which is even, changed as of this morning, some of the guidance that's been coming out. So what's new, kind of what we'll be talking about today, the latest on forgiveness, revisiting the good faith certification. There's been some probably articles you may have seen on that, so we'll give our thoughts on that, as well as the recently announced SBA review process for loans greater than 2 million. And then Jason will bring it home with the always interesting tax updates, and the IRS is certainly keeping him on his toes with some of the recent guidance that's come out. So quickly reviewing Forgiveness 101, now that more companies are receiving PPP funds, like Jason said, a lot of our conversations are advancing towards the forgiveness element of the program. So as a brief reminder, 75% of the proceeds must be used for payroll costs, and the other 25% can be used for other qualified expenses, such as rent, utilities, and loan interest, which sounds easy enough, but as we dive deeper into some more specific examples here in a few minutes, these items get more and more difficult to answer definitively without further guidance of the SBA. So we get a lot of questions on utilities. What is included? I think the spirit of the policy is really meant to cover recurring expected utilities. So anything from electricity, internet, cable, water, that sort of thing. We've gotten more specific questions on, like, what about common area maintenance fees or condo fees? I think we'll talk about a little bit about those later. So that kind of gets, a little bit more detailed. Rent, as far as the Act states, and based on our interpretation of it, it says rent pertaining to a lease agreement. So again, obviously that would include rent for facilities, and then kind of looking ahead, does that include rent for equipment, especially when you start diving down into operating leases versus capital leases? There's still a little bit more guidance that we're needing there, but again, we'll go into some of these in a little bit more detail. Keep in mind that you can only be forgiven for what you actually spend. So if a company borrows, let's say, $1 million and uses 750,000 of that for payroll and only 50,000 for rent, utilities, or other loan interest, that would leave 200,000 left over, and that balance would either need to be returned at the end of the forgiveness or kept and repaid back over the span of 2 years at 1% interest. So that was another question that had popped up here recently. As always, whenever we talk about forgiveness, we're happy to give our insights and interpretations, but remember that it's the lenders that are ultimately processing the forgiveness application, so it's always best to seek their guidance as well on really anything related to these programs. So looking at kind of a sample timeline, this summarizes the program at a pretty high level. April 3rd was the first official date when applications were accepted. And as Jason mentioned, the first round of PPP ran out less than 2 weeks later, and we were into the second round now, which seems to be lasting a little bit longer. The average loan size is actually smaller. So it seems that there's more loans going out, and more of those loans are going to smaller types of businesses, which is certainly encouraging to hear. So how do we get to forgiveness? The deadline for application forgiveness is not defined that we've seen. Presumably borrowers would be able to submit forgiveness applications as early as the day after the coverage period ends. But again, I mean, I don't think that's going to be a requirement to submit forgiveness that quickly. But we're anticipating some more guidance coming out on this. So this is really just meant as kind of an illustration purpose, again, to summarize the entire process of this. So the coverage period, most are probably familiar with, is 8 weeks from the day the loan is dispersed. The act is pretty clear on when the coverage period begins, and that is the day that loans are actually received and are able to be spent by the borrower. We do know that once the forgiveness application is submitted, the lender has 60 days to process and issue the forgiveness to borrowers. So that's, you'll see there kind of on the back end of this. And these two blue boxes are really what we're hoping to get more guidance on, is when the forgiveness application should be submitted, what that application will actually look like, because that has not been posted yet either. And is there a deadline to actually apply for forgiveness? There'll probably be some guidance around, but again, nothing has been issued that we've seen. Friendly reminder too that the last day, at least at this point, to apply for the PPP is June 30th. This still seems far off, but again, kind of considering what's going on with the funding and it running out, we certainly encourage anyone who hasn't applied yet to strongly consider doing so if they do determine that they need the funds. Let's see. So diving in deeper into the forgiveness adjustments, this slide was in our first presentation back in the beginning of April, and I'm still looking forward to the day when I can fully explain how to calculate this exactly. But to review, the PPP is meant to keep employees employed. So if the average FTE headcount during the 8-week period following the loan funding is lower than compared to either option 1 or 2, the forgiveness amount would be adjusted downward by using this type of formula. So this adjustment exists presumably because when the loan was calculated, remember that it was based on historical average payroll costs. So let's say for a company that had 50 employees, if during that 8-week period, this particular company's headcount falls to 40, then the borrower's payroll costs would be lower, prompting this adjustment to lower forgiveness. So I know that's kind of a vacuum example, and in real life, it's going to be much more complicated, but that's how we think this is meant to work. Oops. So if an employee is terminated or resigns on their own accord, this would probably trigger a forgiveness adjustment. If the company is able to hire a replacement for that departing employee, then that would work to, or should work to, offset that forgiveness adjustment. Again, this is based on the number of FTE headcount, not necessarily the individual employees. It's more so on the total. So there is a special exemption for employees that were laid off, which I will talk a little bit more about on the next slide. What we're desperately hoping to better understand from the SBA is the definition of FTE. There seems to be a general expectation within the industry that FTE is expected to be defined as 30 hours per week, but that has not been stated by the SBA or Treasury as it specifically pertains to the CARES Act. Let's see. So rehiring previously laid off employees. This is recent guidance. I think it came out yesterday, but it basically states that if a company lays off an employee and then goes back after receiving PP funds and tries to rehire them, that employee may choose to decline the rehire offer. So if that is the case, then companies will not be penalized for that, provided that the borrower must have made in good faith a written offer to rehire. The employee's rejection must be documented, and also keep in mind an employee who rejects a rehire offer may wind up forfeiting eligibility for continued unemployment. So that is referenced in the SBA FAQ number 40. So if that this particular situation applies to you, I would certainly recommend going out and reading that. One other thing, just to kind of clarify, remember that in order to qualify for the PPP in the first place, in general, most employers must have fewer than 500 employees. And there are some exceptions for certain industries like food services, but we're not going to go into that here. So to further expand on the 500 employee test, the SBA released an updated FAQ yesterday, clarifying that all employees, which would include part-time employees, are considered even employees of U.S. and foreign affiliates. So I only mention that to in an effort for companies to really keep track of employee headcounts, because when you're applying for the PPP, the headcount is based on total employees. When you're applying for forgiveness, it's for FTEs only. So it's a little bit of a nuance there, and just want to make sure folks understand that. The second forgiveness adjustment is related to salaries, and this operates in a somewhat similar fashion as the first adjustment, in that any salaries that are reduced within the cover, or any salaries that are reduced by more than 25% need to be restored prior to, I think it's June 30th again on this one, in order to qualify for full forgiveness. So the nuance with this one is that that coverage period is 8 weeks, and the statute says, that underlined portion in the gray box here, that you have to compare the salary to the most recent full quarter. So that could cause some confusion. What we've seen from the AICPA is that they recommend conducting the analysis on a weekly basis, because if you compare an 8-week period with a 12-week quarter, obviously there's going to be a huge decline in apparent salary, which may not be the case. So that's something to note as well. So kind of getting to the crux of all of this, we've got, in the last few days, received a record number of questions from this audience as it pertains to inquiring about specific questions, which is fantastic, honestly, because it helps us put these presentations together and cover the issues that are most relevant to our listeners. So we tried to pick out some of the more interesting questions to highlight here. The first three are hopefully pretty straightforward, but stipends, bonuses, and hazard pay are considered cash compensation. I would caution on paying extremely large bonuses unless there is a highly justifiable documented reason for doing so, because that's something that could ultimately come up in an SBA review if the SBA review were to occur. Remember that all cash compensation, which would include salaries in excess of 100,000 per year, is not forgivable. So if you kind of do the math, the max that any employee can receive and the borrower still be forgiven is just over 15,000, which is 8 weeks worth of 100,000 essentially. And the hazard pay came up here just recently. There was a webinar with hosted by the National Small Business Town Hall. And so it seems like based on what I saw there, hazard pay related to COVID-19 concerns could be forgivable as well. One of the most common questions that we get is the timing of the covered period and a company's pay period. So the CARES Act states that loan proceeds must be used for payments during the 8-week period. What we're not clear on is if it's strictly on a cash or accrual basis. This is a question that the AICPA has been requesting guidance on from the SBA, as well as a lot of other firms are as well. So if a company receives PPP proceeds today and has a pay period this Friday for the last 2 weeks, can that company use proceeds for that entire pay period? We haven't really seen explicit restrictions on this, and from what we know today, a borrower using PPP proceeds for its next pay period that falls within the covered period is within the spirit of the policy. But again, we'd like to see a little bit more further guidance on this. So moving on, several borrowers have asked about prepaying expenses like salaries, rent and interest. And I think I'm kind of jumping around here, but I'm on the non-forgivable expense there. And to our knowledge, over prepaying is not allowed based on the guidance that's available today. It really is meant for costs that are occurring in that 8-week period. So prepaying your rent for the rest of 2020, I think, is a little outside the scope of the policy here. And that 25% limitation kind of naturally limits that to some extent. On 401k contributions, several have asked if they can use the PPP funds for their annual matching contributions. We aren't confident enough on this one to say that this would be forgivable, since this represents more of an annual cost related to the previous year versus costs kind of within this COVID-19 era. Um, if the question is using PPP proceeds for 8 weeks worth of 401k matching, then that seems a little bit more reasonable, and could potentially qualify. But again, we don't really have a concrete answer on that one. Severance costs, some have asked about this for an employee who moves up scheduled retirement. I think this is a great question. From a common sense standpoint, I would like to see something like this forgiven, especially if the employee is moving up retirement with the overall intent to save the company money and help them survive. I mean, I think that's about as good faith as you can get. In this situation, the borrower can probably make a strong case for this, but again, it's something that we need some more guidance on before we could say anything definitively. Shared maintenance costs, I alluded to this earlier as it pertains to maybe an office park or a condo. The CARES Act says rent from a lease agreement is a qualified cost. So looking at this in black and white, this type of cost might not be forgiven. However, if these maintenance costs or maintenance fees include some form of utilities, then there could be more of an argument to be made for forgiveness. I think this one depends on what kind of documentation is available to support the overall application. But again, we just haven't seen anything concrete on this. So where does all this leave us? Remember that the PPP loans are meant to be forgiven. It's the whole point of this program, and it's designed to help companies survive. So for anyone listening who's maybe concerned about forgiveness, I would leave you with, I guess, 2 closing thoughts. First, in this state of affairs, when there's a large lack of clarity from official sources like the SBA and federal government in multiple areas, I personally would like to believe that if a business owner who is truly impacted by COVID-19 and who reasonably interprets official written government guidance in determining how to spend their PPP proceeds should be able to make a strong case for forgiveness. Secondly, keeping accurate records during this coverage period and having historical financial records available to support any decision criteria that business owners are making when they're using these proceeds should be extremely helpful down the road. So that may sound subjective, and it is. Again, as Jason said, I think the SBA and Treasury have done a fairly understandable job in providing the continual guidance given the pressure that they're under. So it is constant, the guidance coming out. So our goal is to keep everyone updated to as best we can. The underlying theme, I think, from my perspective, is acting in good faith, and that's something that Kevin can expand upon here next. But appreciate you guys dialing in and keep the questions coming. Kevin, I'll pass it to you.
Thanks, Eric. This is Kevin Stewart. I'm an advisory principal that leads the client accounting services practice, as well as some of other advisory things. I've spoken to many of you specifically about this, and maybe you've spoken to John Kelly, who's also on the team for the SBA, the B&V SBA team to help address these questions. But what is the thing about good faith? And when you went through the loan process for the PPP, and even in our previous webcast, we talked about there was a certification process. A lot of this burden or the risk to the bank is being passed down to the borrower, just from a perspective of getting the money out quickly. And so that good faith certification just succinctly says current economic uncertainty makes this loan request necessary to support the ongoing operations of the client or the applicant. 3 weeks ago, 4 weeks ago, when that application was put in, there was a lot of uncertainty about what was happening and what was going forward. So the good faith effort was, maybe your business is going strong, but some of that business is drying up, 3 weeks from now. Those new contracts aren't being signed. And so there's concern and likelihood that maybe there's going to be a cash crunch. So really in this process that borrowers must make this certification in good faith. And so it's taking into account your current business activity and then kind of looking to the future as well, as long as in addition to your liquidity and what you have available to you. You know, a lot of the conversation initially around this was you don't have to, this doesn't have to be a last source effort, right? You don't have to seek funds elsewhere. But I think on the other side of that too, are there funds available to you that you had available to you? If good faith is not determined to have been entered into, or good faith was not used, and that was the assessment by the SBA or Treasury or whomever, then the consequences of that are pretty significant. And it's $1 million in fine or up to 30 years in prison. It seems extreme. It seems kind of an outlier, but that is, I think they're trying to get a point across. I think with that, the borrowers, as of yesterday, that was changed from May 7th to May 14th to return unnecessary funds borrowed. And so a lot of the conversations that Jonna and Eric and I have had recently with clients and potential clients and prospects just in general about this is there's a general nervousness of we think we need the money, but we don't necessarily want to be, approached by Treasury and kind of investigated and reviewed because, what if they determine elsewhere, determine that we weren't acting in good faith. And that's a tough one. I think if we go to the next slide, then we get to more of this. The way that the law is written and the way that necessary is written is pretty vague, and that there's a vagueness doctrine. There's a lot of case law out there. There's some pretty good articles written in Forbes and some other places that kind of talk about this. But how does a business define necessary in the context of this crisis that we're going through? What's necessary for me may be different than necessary for someone else. My interpretation may be different from the SBA's interpretation. Some of that vagueness doctrine, which is just to read here, is a statute which either forbids or requires the doing of an act in terms so vague that people of common intelligence must necessarily guess. And I think that's the instance in a lot of this. As we've gone through this process, I think that the goalposts have shifted a little bit. The game has changed, and there's additional information that is out there. I think with that, that's why they've allowed the extension to May 14th to return funds. If truth is that you don't really need it, right? The circumstances weren't as bad as you thought it was. You weren't impacted. The forecast in the future isn't overly negative. So you have that opportunity to return that. I think that's also part of that good faith effort as well as the good faith understanding of do you really have a need? Now, based on the need itself, the borrower must determine the necessity. And you did this in the beginning when you applied for the loan. As additional guidance has come out from the SBA, you have another opportunity to reevaluate. Are these funds that you really need? And so the question becomes, what has been the historical impact on your revenues and expenses for the last 6 months? What are your forecasted going forward? We get into the accounting side of it. Is your goodwill impacted? I think it's kind of the same analysis. You're forecasting forward based on consumer habits of right now, based on your customer habits, based on your vendor habits. What is the impact, and what do you project that impact to be going forward? And is it just for the next 2 months, or is it for the remainder of the year or longer? A lot of businesses have cash on hand. They have the ability to get two or 3 or 4 months. But when you talk about getting through a year, it becomes a whole different question. It becomes a whole different, and so we really don't know what necessary is right now for you. So it's up to us individually to determine that. It's possible that some of your key employees contracted COVID-19. If that's the case, then there becomes even a greater impact on your business, and there becomes a true need. Also, economic hardship. We talked about the EIDL loans in the past about substantial economic injury, and although I don't believe it's quite as it's not to that level of substantial economic injury for this good faith effort. I do think there's a component to has there been economic injury? Do you expect economic injury? And it's being able to quantify that and develop that and argue that, and it's really just taking a reasonable position, as Eric mentioned, with some facts. With some facts in hand and some good estimates and just a reasonable estimate of kind of where you're going. So I think each of this is defendable, but each business is different. And it may be appropriate to engage an attorney, to engage your internal counsel, external counsel, to kind of talk through this, because a lot of this doctrine or a lot of this vagueness and a lot of the definitions here, it's really legal related. And so the bankers will provide some assistance, and yet at the end of the day, it's the SBA and the Treasury making that decision. If we go to the next slide, we kind of get more into what's the SBA review look like. I think Mr. Secretary Munchin came out, and I probably said that incorrectly, so I apologize to him. Don't audit me. But he came out, I believe about it was a week and a half ago, and noted that any loan in excess of $2 million was so subject to review, called audit of that lender's submission of forgiveness. And so the question becomes, they wanted to put some teeth in it. Are the right, there was some bad press related to, I think it was the Lakers, Los Angeles Lakers, Ruth's Chris Steakhouse, Harvard even, and some others that were some well-known entities that was a little bit of a black eye for them because they got these funds, but by all accounts, it seems like they're doing okay, right? And so because of that bad press, it seems like there was a little bit of a knee-jerk reaction to come back out and say, we're serious about this. Only those people who need it should be borrowing it, and you have this opportunity to return it. And so that necessity of the loan, and Eric mentioned something, this all was intended to be forgiven, but the way that the Congress intended to get it to the businesses was through a loan format. And the best way to do that on the end of that is offer forgiveness with the intention of, we want to give this to payroll. What is the big picture of this? We want to provide money back to the employees so that they can continue working, so they can continue producing. And so with that, the forgiveness piece was really a reinforcement, which is a lot of tax laws, a reinforcement of something the government wants us to do. In this instance, it was to pass that money on to our employees. It's going to be, so this loan review is also going to be about use of proceeds, and it's going to be about forgiveness adjustments and related to FTs and et cetera. I think the first round of loans we saw, there was approximately 25,000 in loans that were greater than $2 million. The second round of loans, the second tranche of funds, as of yesterday, I believe it was, there were only 7,000 or 8,000 additional. So all in all, about $32,000 to $33,000 in loans have been greater than $2 million. Do they have the ability to audit or review, 33,000 loans? And the answer is we don't know, but I guess we'll find out soon. And then lastly, we've talked about really, and Eric mentioned, we talked about documentation and how do you track so that you can be prepared for a review or you can be prepared for forgiveness. And it really becomes deliberate record keeping. Some of the things that Eric was talking about around, the timing of payroll and prepaying of payroll and bonuses and 401ks and all those other things. It becomes, what is your methodology and your approach to doing it, right? Is there logic to what you're attempting to do, and can you support it? So the things you will need will be payroll tax reports. ADP, Paychecks, and all those other payroll providers have been very good in this process of stepping up and giving us the information, each of us the information we need for loans and for additional information, and they will continue to do that. They'll continue to work with us, I'm confident. Employee gross wages for that 8-week time period. And for the previous quarter as a comparison. And we go down to average AFTs. And again, we still need a little bit more guidance on what that looks like as far as, is it individuals by themselves or is it cumulative? And our best guess is it's probably cumulative to kind of get to that FTE number. But we do need a little bit more guidance on that. So being able to calculate and defend the FTEs that you've used. Healthcare benefits, what are the cash payments? And it's not just about cash out the door or bank records, it's about the actual invoices and proof of what it was going for as well, retirement plan benefits and otherwise. And so with that, this is, if you narrow it really down, it's taking the big picture of what all this money was intended for. It's evaluating if there's a real need on your basis. And if you believe there's a real need, it's being able to defend it and quantify it and taking a reasonable estimate, a reasonable approach to it. When it comes to the vagueness, because there's vagueness and because there's gray area there's a lot of leeway coming up with what the right answer is. Is it really prosecutorial, based on what you've done, or if they determine that it's not really needed? It's hard to say. But all in all, if you go through with a good faith, if you keep track of your information and you have deliberate record keeping, and you provide all that up for forgiveness at the end of the day, I think you'll be in a pretty good position, at least a defendable position. With that, I'm going to hand it over to Jason Sharp, our very strong tax partner, to walk through the remaining 20 minutes here.
Thanks. And, I realize I'm only supposed to, I want to stay in my lane. I'm supposed to talk about tax, but the one thing I would mention, and I know Eric and I have had this conversation before, is, stepping back, we've, responded to client questions, and a lot of people will say, oh, that's not going to be forgiven. This is, this isn't fair or whatever. And it may or may not be, but, stepping back and looking at the end of the day, if it's not forgiven, it turns into a 1% loan. And so, I'm not sure that's exactly a horrible situation to be in. I mean, not too many of us are able to go to our banks and get 1% loans that are 6 months deferred. So, while this system is less than perfect, your worst case scenario of that is maybe not huge. So sometimes, stepping back and looking at that versus getting hung up on, maybe some perceived unfairness. But anyway, on to the sexy tax stuff that I know you all came for. I mean, it's just like a concert. That was the opening act. This is the headline, the tax. So I don't hear anyone laughing. I'm assuming it's just because y'all are all muted. So this came out last week, and it's gotten a lot of press, this item on the slide, and it's the tax deductions related to PPP forgiveness. So the CARES Act is incredibly clear. It says in its, the face of the statute that any amount forgiven is not to be taxed to the recipient. Typically, in a lot of situations in the tax code outside of this pandemic, if money is forgiven, in certain situations that can become taxable income, cancellation of debt income to the borrower. And so they wanted to make it very clear here that any money that was forgiven was not intended to be taxed to the borrower. Well, the IRS came out last week and issued this notice 2020-32, and they said, oh, hey, by the way, we're just going to let everybody know that whatever you spent the amount of your PPP loan on that was ultimately forgiven, you can't get a deduction for that. So thinking through this, let's say, someone loaned, got $1 million loan, and let's say they spent it all on payroll. Typically payroll is a deduction. So they would have $1 million deduction for the payroll and not have to pick up the income. However, the IRS is basically saying you wouldn't get that $1 million deduction, which if you kind of go through the calculations, it's a little bit of a backhanded way of making that forgiveness piece taxable. And so the IRS was saying that they have a basis for this because it's related to some rules under, I believe, 265 and tax exempt income and all of this kind of stuff. I shouldn't say most, there are a number of commentators who are like, hey, whoa, wait a second. IRS, you cannot make statute. Congress and the Senate make statute. You are relegated to interpreting the statute. And many feel like this comment from the IRS is beyond that because they are basically taking something that would be deductible under 162 in the code as an ordinary and necessary business deduction and saying you can't deduct it. And there is nothing in the CARES Act that says that. So a lot of folks are kind of scratching their head like, hey, IRS, thanks for giving us guidance as fast as you can, but you can't just make this stuff up. And in fact, the Finance Committee Chair Chuck Grassley, the Finance Committee works on a lot of tax provisions in the Senate. And he basically came out and said that he was very disappointed with this guidance and that notice is contrary to the intent that the lawmakers had in making the law. So there has been some rumblings that they are going to go back and amend the CARES Act to add language granting borrowers the deduction whether or not the amount is forgiven. So I can't tell you definitively where we're at on this. I would tell you probably the best thing is kind of stay tuned. So the IRS has sort of launched the first punch and said anything forgiven is not deductible. So just be aware of it because technically that would sort of be where we're at right now. But it's going to be real interesting to see if that changes, if someone sues over it as overreach or what. But my guess is we're going to hear more about this. I don't think this is just going to sort of, quietly pass in the night. Next slide. Oh, and before we get on with this next one, just another comment. There was another instance of this where the IRS issued some information about tax credits and even admitted that their interpretations that they were promoting were against a report from the Joint Committee on Taxation, which is who writes the law for the House. They said, yeah, we realize what we're saying goes against what they talked about in this report, but we feel this is necessary. So again, that was just another example, not related to deductions. It was related to some tax credits, but there are a few people in Washington who think the IRS is already playing a little fast and loose with this. And so it'll be interesting just to see where it goes. So this next slide is the delay of payment of the payroll taxes. So we've talked about this in our other presentations, but I think it's an important thing, and we still continue to get a lot of questions on it. So we did want to just sort of touch on this. So in the CARES Act, it said that employers could defer payment of their portion of the Social Security tax that was paid from the date the CARES Act went into effect, which was March 27th, through the end of calendar 2020. So basically, whatever an employer owed for Social Security tax from that period, they could defer paying that. So basically, you would incur the expense, but you didn't have to make the payroll tax department. You could keep that cash, and then you would have to pay half of it, whatever that amount was, by December 31st of 2021, and you would pay the remaining half by 2022. So this is not a forgiveness or a permanent deduction, but it's the next best thing, which is deferral. So the language in the statute was a little unclear because it sort of sounded like if you did this, you couldn't get a PPP loan, which is the case with employee retention credits, which is another thing we've talked about in our other presentations. That is mutually exclusive. If you take those, you cannot take a PPP loan. But the Treasury has come out and said that is not the case with the delay of payment of employee payroll taxes, and they've actually provided guidance on that. And we have the website there on the slide. Next slide. And that link is to an FAQ, and question number 4 from that said, can an employer that's applied for and received a PPP loan still defer making their payroll tax deposits under the provisions in the CARES Act? And so the answer to that is yes, you can. The way this works, though, is whenever the lender determines the amount of my loan that is forgiven, then I can no longer do this. So remember, I'm allowed to defer payroll taxes through the end of the year per the CARES Act. So what this is saying is you can defer payroll taxes right now, but whenever that determination is made, then you have to stop. And so then you can just think of whatever bucket of deferred payroll taxes I've accumulated to that point, half would be due at the end of 21 and half would be due at the end of 22. So it's not mutually exclusive. You can sort of get a little bit of it. And again, it's not all the payroll taxes, it's just the employer FICA. But we appreciated this guidance because that was a big source of contention. Next slide. This just came out yesterday. The IRS has added an FAQ on some of the retirement plan distributions and loan changes. You may remember that some of the provisions in the CARES Act significantly loosened the ability for folks to take money out of their 401ks and IRAs, and they were able to do so and not pay the 10% penalty that may be applicable if they're under 59 and a half. There would not be the 20% withholding. There would be deferred time that the tax is due. They could make it a loan and pay it back over 3 years. So there was a lot of flexibility. The CARES Act, it was very taxpayer friendly in allowing folks access to these retirement accounts in obviously what is a dire time of need. So they are basically this FAQ page. They came out and said, we're going to be issuing more guidance, but here's a hint of what that guidance is going to look like. So they offered similar provisions around retirement accounts back when Hurricane Katrina came in 2005. And so basically the IRS said yesterday, under the Katrina Relief Act in 2005, they issued a notice, 2005-92. And so to the extent the provisions of that Katrina Act are similar to the CARES Act, and there is a lot of overlap, the way we are going to treat these issues in the CARES Act will be extremely similar to the way. So basically, the punchline to this is the IRS is going to be providing more guidance. But if you kind of want a preview of what that guidance is going to look like, you could go to this notice from 2005. And for those of you who are wondering why they keep issuing sort of these FAQs, and I think we may have mentioned this in previous presentations, but basically, again, it's because this thing is going at 90 miles an hour, and that's really the fastest way they can get information out. So when a law is passed, the IRS has the authority to issue regulations, which are almost, I mean, they're sort of, the next best thing to a law. They have a lot of weight and teeth, and because of that, the process for the IRS and Treasury to issue regulations is incredibly lengthy. There's a lot of protocols, there's a lot of quality controls, there is a lot of internal review, and it can take months and months, if not years or more, to issue regulations on a particular statute. So what the IRS is doing here is they realize from a practical standpoint, there's no way they could issue regulations on this because it would be so far after the fact, it wouldn't do any good. So their internal process for issuing FAQ pages is a lot easier. And so it's kind of the most efficient way for them to get out information in a really short order of time. And again, as we've mentioned before, I've never really been a huge fan of a lot of IRS Treasury materials, but the ones around this have actually been pretty well done. They update them almost on a daily basis with new questions, and a lot of them are the common questions that we're getting from a lot of our clients. So I would strongly encourage you, and I think we have some links on our website and in this presentation of where you can go to sort of look for some of these because there's really a lot of good information in them. Next slide. Another thing that came out this week, so obviously with the CARES Act, with the employee retention credits and also the deferred payroll taxes we talked about just a couple slides ago, obviously you're thinking, man, they're going to have to do something on the payroll tax returns to track, what I'm deferring to 21 and 22, or what am I taking as a credit and all of that. So the IRS this week just issued a draft Form 941 that would be not applicable for the first quarter, which was actually due April 30th, but it will be due starting the second quarter of 2020. So you can go to their website. They have the draft form. They have the draft instructions. You can see what that's going to look like. And they've also got I believe they had in their notice, some other information about it, but it's pretty self-explanatory. But for those of you who maybe do your own payroll, you might want to just check this out and see how it looks different. Again, a lot of the payroll deferrals started in March 27th, but for most folks, they kind of just let the first quarter go and have maybe started with the second quarter. So this updated form should be able to take care of that. Next slide. One other thing we just have mentioned in talking with a lot of different people is the chart here on this slide. This is the estate tax exemption that has been available to taxpayers from 1997 through the current year. And as you can see, it has just absolutely skyrocketed from $600,000 to now, a little over 11.5 million. So what does this mean? This means that I can give away from my estate up to $11 million and it will escape the estate tax. And so that can happen at the time of my death, or I can make gifts during my life and file a gift tax return and say, I want to use a portion of my lifetime exemption. So the reason we point this out is many people think, depending on how the election turns out later this year, or just, you know, with all of this bailout and stuff going on and the deficit beginning to get really big, you know, there might have to sort of pull back on some of these tax laws. So many people think this high estate tax exemption we are enjoying right now is not going to last for very long, and it's going to come back down to levels where it's been in prior years. And as you can see, it's, you know, in pretty recent history, it's been considerably lower. So if you sort of step back and think about this is historically the time I could give away the most. And also, if I'm going to give away part of my business, and we think of this in sort of a family transition plan, if I wanted to, you know, transition ownership, you know, some or all of my company to children, or, you know, somebody like that, I can use this lifetime exemption. So if you think we're at a historically high exemption amount, and now with, you know, the way the economy is, if I was to value the equity in my company right now, it's probably never been lower because, you know, just sort of the economic environment we're in. And so many people are saying this may be a good opportunity if that's a situation that you find yourself in, that you wanted to transition certain parts of your business. Now would maybe be the way to maximize that benefit, because your business's value may never be lower and your tax-free gift may never be higher. So those are just sort of two things kind of making a perfect storm. So there's been a lot of talk about that. You can find a lot of articles, or folks in our office would be happy to talk through what that would look like if that applies to anybody. But just kind of a unique, you know, you sort of feel bad saying opportunistic with what all's going on, but it is sort of a unique set of facts that makes for this. Next slide. So I think, you know, we're certainly here to help anybody in any way that we can. Here on the slide, we have several different services that we're able to help folks out with. We have a team of people that are putting together models and templates to help calculate forgiveness. Those templates are constantly being updated as new information is made available by the SBA and Treasury. And it's sort of vetted through our CARES Act and SBA committee to make sure we're all in agreement. And so we'd certainly be happy to work with any of our clients to help them go through any of the forgiveness calculations. You know, any of the expense monitoring, that sort of, you know, how that would look through the forgiveness, you know, tax implications and planning related to this, you know, loan reviews, any of that type of stuff. We're certainly happy to speak with any of y'all and see if you need help with any of those things. We're happy to help. We actually have a banking practice that we have a lot of connections with smaller banks and do a lot of training with banks, and so we're pretty connected with them and can offer I think a lot of valuable information as it's needed. Also here on our last slide, when we send this out with a PDF, I believe these are going to be links to these websites that you can click on. And again, these are what I think are some really good resources. You know, the first one is ours that has links to further things and all of these presentations. But then the SBA website, the AICPA website, which has been an excellent resource for us. And of course, the Treasury Department. If you have any questions related to the CARES Act or PPP loans or anything sort of in that genre, there's an email address. You can send that to us and we will try and get you an answer as best we can. Eric, I'm sure I'm leaving something off. Is there anything you'd like to add, or Kevin? Are you guys muted? Okay, I'm not hearing anything, so.
There we go. I was muted. So,
oh, sorry. Okay, good.
No, I think between Eric, myself, and you, I think we covered it. But we, as you said, we are happy to address any question. There's an SBA assistance email address that I think we've provided there. We generally do answer those by the end of the day. At worst case, by the next day. So we are happy to address any questions, small, large, whatever else, and then get on the phone call with you as well. Again, that may be Eric, and maybe Jason, myself, or John and Kelly as well. But we were happy to visit and talk through any questions you may have.
Yeah, sorry, this is Eric. I was muted too. It looks like we've got quite a few still outstanding questions in the Q&A section of the Zoom meeting there. So we haven't gotten into it yet. I know Rick is furiously typing out.
Yes, this is Rick in the back, and my fingers are broken.
I figured that was probably the case. They're probably on ice at this point, I hope. But we will get to those for those who have asked and we haven't gotten back to those. We have those recorded. But if you don't hear from us again, definitely send us an email as a good follow-up.
And thanks for joining us. We will certainly make you aware of any other future webinars and would welcome attendance. Thanks to everybody. Stay safe, and we'll talk again soon. Thank you.